Hi, Julia. Hi, Nick.
Hello.
Hello. I think we can start.
All right. Welcome, ladies and gentlemen, to this latest investment update. Yeah.
Just to Nick, one moment. I think Alex want to say something.
Oh, of course, of course. The floor is yours, Alex.
No fighting. You're here for the content, and it's my pleasure to welcome all of you. I understand that I'm between you and Nick, who will walk you through something which we think is really important to do in these times of uncertainty. Because I think everyone's reading the news. We are not here to comment the news, but to help you really make sense of what you're reading and how geopolitics is more than just tanks, and how you can advise customers, and how we see that our model-based approach helps you and your customers to kind of maneuver through these times. As always, I would like to thank the team setting up. Please, Nick, the floor is yours. As always, feel free to write questions into the chat. And above all, I hope that you're all safe and sound. Thank you very much. And over to you, Nick.
Thank you, Alex. So welcome, everyone. Geopolitics takes the center stage. We have a lot to talk about today. Before we get into the agenda, though, here's a brief disclaimer as usual. Now, I'm not going to read this all out for you guys, but long story short, please don't do anything silly based on the information that we're going to give you today. And talking about the information we're going to give you, we have split the presentation into 3 parts, as usual. So first things first, we'll do a bit of review in February, have a look at what various markets have been up to off the back of this conflict between Russia and Ukraine. We'll have a look at how we are positioning our portfolios in all this, what kind of risk mitigation strategies we have in place. And last but not least, we'll go through some key questions that have come out of this conflict, which are important for investors. So let's start with the markets. As you can see here, European markets have been very much adversely affected by the Ukraine conflict. You can see here on the left, the German market is down precipitously, quite strongly in February. We see that in Italy as well. So these are markets that have quite a close connection to Russia. Think about the energy imports coming from Russia. So it's quite important for Europe. So Europe's been especially badly hit here on the back of this conflict. If you look at the United States, though, so the start to the year hasn't been great, no doubt about it. But in terms of the impact of this crisis, it's been fairly limited. So markets have been essentially flat in February. So if you look at the S&P there on the left-hand side, essentially flat, come up a bit again. If you look at the NASDAQ, something similar has happened. It's even less so, less down than the S&P 500. So the US, not great, but it's fairly insulated from this conflict. Now, an area that is not at all insulated from this conflict is, of course, Russia. You can see Russian markets are down like crazy so far this year. So if you look at the Russian stock market there on the left, started the year at 1,600 and has collapsed to below 800. So it's been cut in half. It's been really dramatic to see these kind of falls. We don't often see them. And if you look at the Russian currency there on the right-hand side, the Russian ruble versus the US currency, but also versus the euro, you've seen a very steep fall as well. So last weekend, the currency fell by 25%, which is absolutely extraordinary that we see those kind of currency moves, even in emerging markets. So the situation in Russia is not good. The situation in Europe is not good either. And here, if you look at our funds, so for the DRC, which is the flagship quant fund, there, the start to the year hasn't been fantastic either, due to this conflict, but also due to rising interest rates and higher inflation. But we're still overall in line with the market. If you look at the Lucy Global Fund, something similar has been happening here, also been hurt by higher interest rates, by higher inflation. And also now the Russia-Ukraine conflict has also been impacting the fund. But if you look over the last 12 months, performance is still decent. But the situation right now merits some closer attention. So what exactly is going on here? Well, the reason that markets, especially in Europe, have moved so violently is because Russia has actually chosen to invade all of the Ukraine, as opposed to just keeping pressure on the government and maybe taking some of the eastern provinces, which was largely expected in the markets. What wasn't expected was a full-scale invasion, and that's exactly what Vladimir Putin has done. And it's very clear now that what Putin wants to do is that he wants to change the government in Kiev. He wants to put in a puppet regime, someone who's in full alignment with Moscow's wishes. And behind the scenes of all of this is part of an underlying geopolitical strategy that Putin and Russia have been pursuing over the last 20 years. What they essentially want to do here in their thinking is they want to make Russia the dominant power again over the ex-Soviet bloc. So make them a strong regional power, ideally a strong world power that can push back against US interests. It feels that the Ukraine being independent and moving into the Western sphere is a key strategic error on their part. So it's a clear threat to their goal of re-establishing dominance over the ex-Soviet bloc. Here you can see the situation with NATO expanding eastward significantly since the end of the Cold War. The idea has been to get Ukraine closer to the Western bloc as well. This is not something that Putin wants, and he feels like he needs to invade the Ukraine to ensure it does not become a full independent nation. And of course, it comes with a whole lot of terrible suffering on the back of it. It's of course difficult to do these kind of presentations because there is a clear moral element to all of this as well. It's really horrific seeing the pictures coming out of the Ukraine. But okay, so that's explaining the market backdrop here. So how have we been positioning? Well, what we do is we use models to look at the fundamentals. And the fundamentals for us, there are two facets to the fundamentals. We have the monetary environment and we have the economic environment. So if we look at the monetary side of things, things are definitely not ideal for risk assets. Certainly not, such as stocks. So interest rates are going up, especially in the United States. The Federal Reserve has gone into a tightening mode, so raising interest rates, inflation remains elevated. So not good news on that front. But if we look at the global economy is doing very well indeed. Investment spending is moving in the right direction. Consumption is supported as well. The services sector is coming back into form as Omicron is starting to fade. And, the pandemic is now increasingly moving into the rear view mirror as well. And all of that is very good for the global economy. And this can compensate for the negatives that we have on the monetary side and the negatives that we have on the geopolitical side. So here again is an important chart that we showed last time around, is that if there is no recession in the global economy, stocks can still perform. If the global economy is growing, then equities are still the place to be. Now, if a recession does materialize, this changes, but our models are not saying that recession is imminent. Hence, we should still be overweight or highly positioned in equities. And that brings us here to the allocation page. We have that high allocation to equities still in place. So the economic backdrop, economic growth environment is still good enough for performance in stocks. If we look at bonds, though, there the situation is different. So we have a low allocation there. Why? Because a higher inflation, higher rate environment is bad for bond markets. Within equities, we've also been making a change over the last number of months with a clear preference for value stocks over growth stocks. Again, value stocks perform much better in more inflationary type of environments where interest rates are going up. In more practical terms, that means in sector allocation terms. So we want more energy as opposed to technology, which is much more interest rate sensitive. Now, this doesn't mean, however, that we're not looking at the risks related to this conflict. And there are certainly risks. And there are two main risks that we want to highlight here. And the first key risk that we need to bear in mind is the risk of a full-fledged war between Russia and NATO. We don't need to go into too much detail. This is really a doomsday type of scenario, and the uncertainty around this, of potential nuclear war, for example, business sentiment would collapse, consumer sentiment would fall through the floor, markets would collapse as well. So that's really the doomsday scenario. But the good news in all of this is that it's not a likely scenario for the markets. It looks as though that Putin appears to like taking risks, but he wants to take risks where the probabilities are on his side. taking on NATO directly is not something where the probabilities will be on his side. As you can see there on the right-hand side, military spending in NATO versus Russia is astronomically higher. So over $1 trillion spent in NATO compared to $60–70 billion in Russia. So he doesn't want to go head to head. So a major escalation here leading to a direct confrontation is still a small possibility. Now, a risk that is more important that we also need to gauge is that we see a major cutoff of Russian gas going into Europe. So this could come, for example, from the European side through sanctions saying like, we're done with you, Russia, you crossed the red line, we're cutting off all energy coming from you guys. Or it could come from Moscow itself, where it says, we don't like the sanctions that you've put in place, we are now cutting you off from importing our energy. The problem with this would then be is that there would be a major escalation in prices. Prices would go up astronomically. A lot of European gas comes from Russia, as you can see there.
Beaucoup de gaz européen vient de Russie, comme vous le voyez ici.
Sorry, unfortunately, I seem to hear one of the translators. Do you mind just muting yourself? Sorry. So a lot of Europe's gas comes from Russia, as you can see there on the right-hand side. As far as Germany is concerned, around 60, 70%. Excuse me, do you mind just muting your microphone? I think it's the French translator. Sorry.
I'm not being assigned as an interpreter, so I don't have any option.
Okay. So again, the good news with this, however, is that it won't likely lead to a recession. There's simply too much to lose for the European politicians. If the European politicians allow this to happen, then Europe would be mired in a recession. And their political interests are just not aligned with that thinking. They do not want to cause a recession in Europe. So again, it's a risk to be sure, but it's a fairly limited risk in our view. Now, we still need to guard against the risks, and we have a couple of elements as part of our investment strategy through which we can guard against risks that I want to briefly explain. We have, for one, volatility signaling, and the other side, the sentiment scanner. So how exactly can we protect against risk? Well, the first part is knowing what kind of volatility regime we're in. We get to find out what kind of volatility regime we're heading into is if volatility starts to escalate significantly. And the higher the volatility, the higher volatility regime we're in, the higher the probability as well that markets do come down significantly. And this is what we can do with this model. And as you can see on this chart here, we've seen this happen throughout February. So when that line starts to go significantly below 100, it means we're moving into a higher volatility regime, and the probability of a drawdown is increasing. So we need to protect ourselves. And the question is, how do we protect ourselves? We protect ourselves using put options. So these are financial contracts where essentially what we can do is we can protect against downside risk. So if the markets go down considerably, the value of these contracts go up. So in a sense, it buffers then against the market drawdown that we're seeing. And the stronger that our signal is in terms of the volatility regime, the more protected the portfolio will be. It can even go up to 100% protection as well. The other element that I highlighted is what we call the sentiment scanner. Just to briefly re-highlight exactly what we mean by this. So what we do with the sentiment scanners, we use machine learning techniques to analyze all global news coming through. So we can scan and interpret all the major news sources from around the world. That allows us to monitor economic data better. And importantly, it gets us closer to seeing the perception of it, the sentiment that is coming as part of this economic data. Perceptions and sentiment are key to the markets. It allows us to understand the markets better, and it allows us then to position ourselves accordingly. So we move towards those assets where sentiment is firmly in an upswing, where it is improving. And where is sentiment in an upswing? Well, we see this, for example, with a higher US allocation that we've seen. So US markets are more immune to this crisis. So we're seeing the sentiment scanner push us towards American equities, which have less exposure to Russia, for example. It's also pushing us towards the US dollar, which again is a good geopolitical hedge. If global uncertainty goes up considerably, people tend to buy the dollar. And that's exactly what we're seeing over the last week. And that's exactly where the sentiment scanner is moving us towards. We also see this then, for example, as part of a higher energy allocation. So during geopolitical crises, especially those involving large oil producing nations, such as we're seeing now, or as we've seen in the Middle East, then oil prices can go up exponentially. Having a large allocation to energy stocks then protects us against this risk, against higher oil prices, and thus against geopolitical risk as well. So one trade that we've been doing, for example, over the last week or so, is a move towards Exxon and ConocoPhillips, which are American companies, so towards the US, also in dollars, and are also energy companies as well. So that's what the sentiment scanner is telling us. So we have these three pillars with which we mitigate the risk here related to this crisis. So on the one side, derivative strategies, so put options are in place. We have a higher US allocation, they're more insulated from this crisis. And energy stocks as well tend to do well during geopolitical turmoil, as we're seeing now. Now, last but not least, let me just go through some key questions that we've already had come in. So for example, which assets, which sectors perform the best in this environment? Well, this is not very ESG, what I'm going to say, definitely not, but defense stocks are obviously one area of the market that do very well. And are probably structurally going to do well over the coming years because we're seeing more rivalry between the big powers, right? With Russia now on one side, America on the other side, China as well. And during these types of scenarios, military spending tends to go up fairly considerably. So the defense area is where it's going to be over the coming years, most likely. Again, that is not an ESG perspective, but unfortunately, that is the reality of the situation. Gold as well is known as a very good geopolitical hedge. So when uncertainty goes up, gold tends to get bought. And that's exactly what we've seen over the last week. So gold is fulfilling its role as a geopolitical hedge, no doubt about it. And energy as well. As we saw, when there's war involving oil producing nations, then energy also tends to do well. Now, what are central banks going to do? This is an interesting question. Well, especially in Europe, I think there will be a lot less concern around inflation. Now, remember, all the talk was around higher inflation. Now the concern will be more about insulating the economies in Europe from the fallout of the Russia-Ukraine conflict. Something similar is probably going to happen to the Federal Reserve. They'll continue hiking rates, but maybe at less of a pace. And it also means that interest rates could be lower now for the coming weeks and maybe next couple of months as well. A final question that we've had is, are Russian assets a buy? Well, first and foremost, this is a moral issue. And I think the majority of us here would say that just on moral grounds, you wouldn't want to be buying Russian assets at this stage. But there are these big discounts, right? Russian equities are down by 50%. So would you see this as an opportunity to go into Russia? Well, there, unfortunately, no. Again, the future does not look particularly bright for the Russian economy. The population is dying. The structural growth rate of the economy is not good. So productivity has been a consistent decline over the last 20 years. So if you want to put long-term money to work, Russia is not the place to be. So that's a no from our side. All right, everyone, we have almost made it. Let me just sum things up with a few key messages. What have we said today? Well, it's been a bad start to the year. It's been a bad February. So we've seen a tighter monetary environment, higher inflation, etc. That's hurt markets. Now we have to deal with a full-fledged war as well between Russia and Ukraine. This raises geopolitical uncertainty. It also means we have to potentially deal with an energy crisis in Europe. But having said this, the global economy is still doing well. We prefer equity still. A recession is unlikely. And if there's no recession, equities are to be preferred, despite this tighter monetary policy backdrop, despite the geopolitical tension. But we do need to hedge against the risk. As we saw, there's a three-pronged approach. We use tactical puts to protect a portion of the portfolio. We move towards US stocks and the US dollar. They're more insulated from the crisis. And we also have an upped allocation to energy stocks, which are also more immune from the fallout of geopolitical crises involving large oil producers. That is it from my side. If you have any questions, please note them down, send them through to the form that will come to you after this presentation, and I promise we will answer every single one of the questions. So with that, thank you very much. Have a fantastic end to the week, and goodbye.